Chapter 30 Corporation, Organization, and Capital Stock Transaction. The corporate form of organization. This definition is the foundation for the prevailing legal interpretation that a corporation is an entity separate and distinct from its owner. Study objective 1. Identify the major characteristic of a corporation. Characteristic of a corporation. A number of characteristics distinguish corporation from proprietorship and partnership. We explain the most important of these characteristics below. Separate legal existence. As an entity separate and distinct from its owner, the corporation acts under its own name rather than in the name of its stockholder. Limited liability of stockholders. Since a corporation is a separate legal entity, creditors have recourse only to corporate assets to satisfy their claim. Transferable ownership rights. The transfer of ownership rights between stockholders normally has no effect on the daily operating activities of the corporation. Ability to acquire capital. It is relatively easy for a corporation to obtain capital through the issuance of stocks. Continuous life. The life of a corporation is stated in its charter. Corporation management. Stockholders legally own the corporation, however, they manage the corporation indirectly through a board of directors they elect.
Government regulations. A corporation is subject to numerous state and federal regulations. For example, state laws will usually prescribe the requirements for issuing stock, the distribution of earnings permitted to stockholders, and the effects of retiring stock. Additional taxes. Owners of proprietorships and partnerships report their share of earnings on their personal income tax returns. Study Objective 2. Differentiate between paid-in capital and retained earnings. Corporate capital. Owner's equity is identified by various names: stockholders' equity, shareholders' equity, or corporate capital. The stockholders' equity section of a corporation balance sheet consists of two parts: 1. Paid-in or contributed capital, and 2. Retained earnings or earned capital. Study Objective 3. Record the issuance of common stock. Accounting for issues of common stock. The primary objective in accounting for the issuance of common stock are: 1. To identify the specific source of paid-in capital, and 2. To maintain the distinction between paid-in capital and retained earnings. The issuance of common stock affects only paid-in capital accounts. Study Objective 4. Explain the accounting for treasury stock. Treasury stock is a corporation's own stock that it has issued and subsequently reacquired from shareholders but now retired. 1. To reissue the share to officers and employees under bonus and stock compensation plans. 2. To signal to the stock market that management believes the stock is underpriced in the hope of achieving its market value. 3. To have additional shares available for use in the acquisition of other companies. 4. to reduce the number of shares outstanding and thereby increase earnings per share. Study Objective 5. Differentiate preferred stock from common stock. Preferred stock has contractual provisions that give it some preference or priority over common stock. Typically, preferred stockholders have a priority as to 1. Distribution of earnings or dividends, and 2. Assets in the event of liquidation. However, they generally do not have voting rights. Study Objective 6. Prepare a stockholders' equity section. Statement presentation. Companies report paid capital and retained earnings in the stockholders' equity section of the balance sheet. They identify the specific source of paid capital using the following classification. 1. Capital stock. This category consists of preferred and common stock. Preferred stock appears before common stock because of its preferential right. Companies report par value, shares authorized, shares issued, and shares outstanding for each class of stock. 2. Additional paid capital. This category includes the excess of amounts paid over par or stage value and paid capital from treasury stock.